The fragile two-week ceasefire in the Middle East is scheduled to expire at 1 a.m. British summertime on April 22nd. Without a last-minute extension, global markets face the immediate resumption of active hostilities. The high-level diplomatic summit in Islamabad has collapsed. Following an internal power shift in Tehran, the Islamic Revolutionary Guards Corps has taken absolute control over the country's negotiating posture, sidelining the diplomatic pragmatists who previously managed back-channel communications. The demands from both sides have reached a stalemate. The United States maintains an absolute requirement for the surrender of Iran's nuclear capabilities, while the IRGC demands total regional sovereignty and the immediate removal of all foreign military bases. This impasse stands in sharp contrast to the 10-day ceasefire recently announced between Israel and Lebanon. That agreement was brokered directly through leader-to-leader diplomacy. However, the deal lacks third-party oversight, and the Lebanese government has no operational control over independent military factions, leaving the northern border highly volatile. The market assumption that we will see a return to pre-war normalization is contradicted by the facts on the ground. Capital allocators must now update their models to price in a sustained generational energy crisis. This is a map highlighting the Strait of Hormuz. This narrow 21-mile-wide maritime choke point has reached a state of zero redundancy. Following executive orders from Washington, the United States Navy has imposed a maritime blockade targeting this northern coastline and all major Iranian ports, restricting transit solely to vessels not traveling to or from Iranian facilities. In a retaliatory move, the IRGC Navy has declared a hermetic seal on all commercial traffic near this southern choke point. They have backed this closure with kinetic strikes on commercial vessels to force ships off course. This visualization maps the total trapped hydrocarbon volume against daily global demand. Exactly 15.5 million barrels of crude oil, 2.2 million barrels of refined products, and a full 25% of the global liquefied natural gas trade are currently blocked from leaving the Persian Gulf. During the tanker war of the 1980s, despite over 500 vessel attacks, the strait remained partially operational. Today, state-of-the-art surveillance and heavy naval escorts have brought the artery to an absolute standstill. The International Energy Agency has characterized this closure as the largest supply disruption in the history of the global oil market. With two adversarial militaries enforcing a zero-tolerance policy, the scale of this disruption now exceeds the economic trauma of the 1970s energy crisis. This geospatial map tracks the deviation of shipping routes. South Korea has secured 273 million barrels of crude oil routed deep into the southern hemisphere. These voyages add up to 6,000 nautical miles, increasing transit times by 15 days and driving massive spikes in freight. Ships are now navigating the rugged coastal geography of the Cape of Good Hope as the only viable alternative to the blocked Middle Eastern arteries. Europe is confronting an existential energy crisis as a result. European TTF gas prices have surged roughly have suddenly removed approximately 17% of total global LNG capacity. Energy experts estimate it will take 3 to 5 years to fully restore baseline production. This global shortage creates a commercial vacuum. While Europe faces economic stagnation and high input costs, North American integrated operators are rapidly expanding their export capacity to fill the void, securing continental energy dominance for the next decade. This energy shock is forcing a reassessment of central bank policy. Because domestic U.S. inflation remains resilient and core metrics are under pressure from new tariffs, the Federal Reserve is maintaining a higher-for-longer interest rate regime. Unlike the energy-independent United States, the European Central Bank and the Bank of England must import the inflation generated by the conflict. These institutions are effectively trapped between rising headline inflation and collapsing domestic growth. This comparative foreign exchange matrix tracks massive capital flows. The U.S. dollar surged 2.4% in March, and the Swiss franc appreciated over 4%. Meanwhile, the Japanese yen's safe haven status has fractured, pushing toward the 160 level and elevating the probability of direct market intervention. Standard monetary easing models are failing to account for this shift. In this environment, a nation's level of energy independence has become a central determinant of its currency's stability and its central bank's policy flexibility. When military operations commenced on the evening of February 28th, institutional liquidity in digital asset markets instantly collapsed. Market data refutes the narrative that Bitcoin acts as a geopolitical safe haven. Within hours of the strikes, over $128 billion in crypto market cap was erased, as institutional capital fled to traditional flight-to-safety vehicles. Furthermore, digital assets are facing a regulatory backlash. Reports indicate Iran explicitly demanded toll payments in cryptocurrency for vessels navigating the strait, utilizing mixers to obfuscate the origins of the funds. This weaponization of the blockchain for sanctions evasion is accelerating aggressive crackdowns by the U.S. Treasury. This chart compares minute-by-minute pricing from the night of the strikes. While Bitcoin plunges, physical gold establishes a firm structural floor. Gold is rallying despite high interest rate expectations, signifying a structural shift in its role as a foundational investment asset. The primary driver is sovereign risk mitigation. Central banks are currently purchasing bullion at 70 tons per month, 4 times the pre-2022 historical average. Stateless digital assets carry significant downside risk during military escalations. Authentic systemic crisis protection requires holding the physical assets that sovereign states are now prioritizing in their own reserves. While central banks accumulate gold, industrial capital is targeting copper. Analysts increasingly refer to copper as the new gold due to its irreplaceable role in EV manufacturing and AI data center energy requirements. The immediate supply-side catalyst is a severe shortage of industrial chemicals. The Chinese government has announced a strict ban on sulfuric acid exports starting in May 2026. Sulfuric acid is a vital byproduct used in heap leaching, the primary extraction method for major global producers. This export ban is choking the global copper supply chain at its source. Because developing new, high-yield mines requires massive capital and decade-long lead times, the industry cannot quickly expand to meet this shortage. This mismatch is forcing a massive M&A supercycle. Institutional capital is aggressively targeting Tier 1 producers and developers holding proven copper-gold porphyry systems to capture the accelerating discovery premium. The intersection of severe geopolitical supply constraints and explosive technological demand has forced a repricing of viable copper assets. The shift toward global rearmament has locked in massive corporate order backlogs through 2027, with major players like Lockheed Martin alone holding over $190 billion in future contracts. However, investors must monitor a structural risk to the sector: inevitable margin compression. This split bar chart tracks the financial reality for defense primes. Exponential top-line revenue growth is being aggressively undercut by shrinking bottom-line margins. Fixed-price government development contracts, combined with supply chain inflation, frequently destroy contractor profitability. Revenue certainty does not guarantee a return on capital. While defense primes are vital portfolio stabilizers, allocators must avoid accumulating new positions at current peak valuation multiples. The overarching directive for the second quarter is clear. Portfolios must transition from assuming monetary easing to securing physical supply sovereignty. Direct high-conviction capital toward North American LNG export infrastructure and Tier 1 copper producers. These entities are positioned to capture the multi-year pricing arbitrage created by the supply vacuum in Europe and Asia. Conversely, portfolios should remain heavily underweight in European industrials. The energy-driven stagflation on the continent warrants a strong short bias on the euro to dollar currency pair. Finally, confirm the necessity of maintaining core, unhedged positions in physical gold. It remains the only viable hedge against the binary risk of the April 22nd ceasefire expiration. The assumption that the global economy will return to the pre-war status quo is no longer supported by the data. Alpha generation in this multipolar reality demands a focus on hard assets, maritime logistics, and absolute commodity leverage.